As we've seen in August, markets have taken a dramatic downturn for the worse. It means that we're now running about 17% down on the year to date, as evidenced by the chart here of the FTSE 100. After, as I say, a steady period during the course of the first 7 months of this year, with that anomaly of the Japanese tsunami, things took a turn for the worst at the end of July, and we can see there the sort of magnitude of the fall. These falls have been comparable to those falls across the globe. And what I suspect it's telling us is that world economic growth is adjusting down. We have seen evidence in the second quarter of this year that the US economy was experiencing a downturn, and I think it's fair to say that towards the end of July the money was on this being more of a soft patch to the US economy rather than anything more notable as a downturn, and actually I still feel that to be the case. I think what we're going to see over the course of the third quarter is that generally economic numbers in the US will be slightly better than the second quarter as the Japanese experience comes back on stream. But I think what the market's telling us is not necessarily what's going on in the third quarter, it's more fretting about what is going on in maybe 2012 onwards, and it's starting to lower those economic forecasts going forward. Now, these things tend to have a train of events, so we've been reporting or commenting upon the strength of the corporate sector, and certainly Q2 corporate results were indeed very strong. But what analysts will begin to do is adjust those lower sort of global macro trends and start to relate it into corporate earnings. So I suspect that we're going to start to see some downgrades or some adjustment down in corporate earnings when we look out into 2012. I don't think 2011 will be materially adjusted, but we'll come on later to some stocks that are beginning to see some profit warnings going on. So, as I say, the FTSE at the moment crashed quickly down to the 5,000 region. We do appear now to be stabilising in that area, but a great deal of uncertainty still remains over this market. We comment at the moment just ahead of Ben Bernanke's speech at Jackson Hole, and there has been some hope that he may come up with some sort of radical strategy plan. I don't think that's necessarily the view as we enter that he can do too much at this stage, but he has at least given a very clear indication that interest rates are not moving for the next 2 years. So I think that was quite a bold step forward for him to lay the guidelines out. Now, I've commented about the sort of threat to markets with the state of the European situation, and this still hasn't gone away. I'm commenting here on the Greek bonds. And we can see there that when we had that bailout plan agreed for Greece, that did bring yields in, but we've rapidly sort of risen back up to the top. There's still some uncertainty here at the moment. We did hear that Angela Merkel is cancelling a trip to Russia in early September, given the importance of what is taking place in Europe at the moment and the need in September to make sure that the bailout goes according to plan. So it really is rising to very much the top of the charts of their urgency. Saying that, I think they've had reasonable success in terms of just addressing some of those bigger sovereign issues in Europe. And here I look at the Spanish yields, and you can see there that the comment that they were going to step into the market and buy Spanish debt has shown you how yields crashed back and now back to sort of non-urgent territory. We're back down to 5% yields on Spanish, and they seem to be holding there at the moment. So at least that's one area of concern that does appear to have been put to rest for now. Now, with this lower economic growth that is beginning to be built into equity prices, how is that impacting on commodities? Well, we can see here, not too badly, commodity prices are holding up. There's definitely a trend lower at the moment, but commodity prices not crashing. And indeed, we did hear this week from Billiton, and I'm just going to pull up Billiton's share price chart here, and they obviously came back quite sharply in anticipation of lower commodity prices, but the results this week indicated that actually from their point of view at the moment there still remains big constraints in terms of supply, so we don't think commodity prices are going to come off too far, and I don't think it will take a lot to actually see money coming back into commodities. The oil price, I think, will be interesting over the next few weeks. There has been some thoughts that with oil being much more of an economic indicator that we could actually see some declines in oil prices. It's holding above the $80 mark here. You can see at around 84 at the moment. But many of the big oil stocks have seen some pretty bruising falls in their share prices. I'm picking up BP here. That is only now some 20% above its crisis level at the time of the oil disaster of last year. So it's given up a good deal of those recovery gains that were seen over that particular period. Just now turning to more domestic matters, and I think whilst this is a relatively small stock, I think it's just something we need to keep an eye on. And Topps Tiles, retailer of tiles, warned that profits are going to be materially below expectations. What they have seen is that whilst in the sort of period between March and June of this year, consumer spending clearly under pressure, but they were holding to a 1 to 2% retail sales decline. In the period of July and August, that's fallen to 10%. So there's been a very, very material fall in retail sales of Topps Tiles. And that is being reflected in some of the bigger stocks. I'm looking at Marks and Spencer here. You can see share price hitting a 2-year low here at the moment. These may have some early ramifications for the UK economy. If retail spending is falling off a cliff so hard, one wonders whether the GDP forecasts that we're working on for the UK are going to be coming under some pressure. That may have some impact on sterling going forward.